Good morning, all. I hope you can hear me right now. So please let me know through the chat box if I'm audible to all. Okay, perfect. So today in this particular meeting, we show how one could automate algorithms through Tradetron and execute the same strategies on Fyers broker. So first I'll get started by explaining the strategy. So the strategy that we are following over here is what we refer to as rolling straddles, where we get started by initiating straddles, and depending on the spot price moving, we keep shifting the straddles up and down and depending on the market movements. So before I start off, may I know how many of you are already trading options? How many of you attending this meeting are currently trading the options markets? Okay. What about the rest? So how many of you are trading straddles by any chance? Fine. So I'm just sharing my whiteboard, and then I'll just start by explaining the strategy to begin with. Then I'll also show you how this can be automated and how we are currently automating it through Tradetron and executing it on Fyers. So to begin with, let me kind of actually say, so we have two styles of trading. So one is what we refer to as discretionary, and the other category is what we refer to as rule-based or systematic. So when it kind of comes to discretionary trading, we'll be looking at the charts, we'll be identifying the price action, and at the end of the day, the decision making would be done by an individual. So the way each person interprets the price or looks at the charts would be in a different manner. And due to the same reason, the view that each one of us are going to take is also going to be different when it kind of comes to discretionary trading. On the other hand side, when we speak about rule-based or systematic trading, we would be spending more time on developing the strategy and developing the system. When the markets are live, all that we had to do is going to be the execution part. We really won't be having to do much with respect to the decision making at the time of the markets, because all our rules for entries, access, everything will be preconditioned. So at the time of trading, it's purely going to be execution that will have to take care when it kind of comes to rule-based or systematic trading. So this particular system that we are discussing right now is specifically for expiry days. And as you all know, on expiry days, as an option seller, you have an added advantage because theta decay will work in the favor of sellers on expiry. So for the last couple of months, we have been seeing a huge change in the structure of the markets, where we see very low premium combined with very high premium spikes in options, which is an unusual behavior from the last couple of months. But generally speaking, expiry days are the days which is the most favorable risk reward ratios for sellers, because theta decay is faster and the risk reward ratios are also the best. So let's get started by understanding what a straddle is first. I'll give a quick introduction to straddle. Already most of you must be familiar with what straddles are, but let's have a small introduction with what straddles are. So when we speak about selling straddles, so it is the concept of selling at the money, call option, and put option together. So when we say that we are doing a straddle, that means we are selling an at the money call option and put option together. So in this process, what we would be getting is, would be getting a payoff like this, where our maximum profit is going to be limited to this particular triangular region, whereas our maximum loss, theoretical maximum loss, is going to be unlimited because the markets can move up or down on an unlimited knot. So theoretically, our maximum loss is going to be unlimited when we are doing a straddle, and our maximum profit is going to be limited to this particular rectangular, to this triangular region. I'll also tell you about the risk management methodologies that we are going to take in order to protect ourselves from this unlimited loss. So I'll just share my charts. So if you have a look over here, this is the charts of Nifty. Okay, and if I'm just having a look at the charts of Nifty, I see that Nifty is currently trading at 18,269. Okay, or 18,264 to be specific at this particular point in time. So now if you ask me what are the at the money strike, then I would say 18,250. So 18,250 is going to be the at the money strike for Nifty at this particular point in time. So let's have a look at what straddle we did. Our strategy would have done an 18,250 short straddle. So Nifty is trading at 18,255. The closest strike or the closest strike at the moment is going to be 18,250. So we would have actually done an 18,250 short straddle. So that is what you see over here. 18,250 call option and 18,250 put option both has been solved. And we have entered into the strategy by creating a short straddle at 18,250. Okay. So let me move ahead. Let's understand for ourselves what is the meaning of doing an 18,250 short straddle. We already understand that by doing an 18,250 short straddle, we are selling another money call and put. But what does that convey to us? So now here, if you have a look at it, 18,250 call option, we have sold it at an average price of 53 rupee, whereas the 18,250 put option that we have sold has been sold at an average price of 20 rupee. So both together, if I'm looking at it, so the call option and put options premium combined together, we are getting a combined premium of 73 rupees. That is by selling the straddle 18,250 call and put together, we are getting for ourselves a combined premium of 73 rupees. So this combined premium of 73 rupees conveys to us that today the market, as the options premiums are priced, the markets are expecting a move plus or minus 70 rupees. So I'll just write this down in the whiteboard. So I'll just write what combined premium is. So CP stands for combined premium. And this combined premium, in fact, conveys to us what is the sum of ATM call option plus ATM put option premiums. So the sum of at the money call option and at the money put option premiums is what we get to know by the combined premium. So here in today's case, the at the money call option and put options combined premium is like 70 rupees. And this 70 rupees conveys to us the fact that from the spot, that is from wherever the Nifty is, market is expected to give an upside or a downside fall of 70 rupees as per the price premiums. So now you could have this question like, how are the premiums priced? So the premiums are always priced similar to the insurance, like a health insurance. So if you are a healthy adult, for you to have a coverage of 3 lakhs, you probably have to pay an annual insurance fee of 5,000 rupees. Whereas let's say that you are someone who is having some health disorders, you are little bit having problems with your health, then your insurance premium might be 15,000 or even 20,000 or maybe even 25 or 30,000 to get the same 3 lakh coverage. So as you know, the insurance premiums are priced depending on the risk the insurance company takes on the individual. On a similar note, the options premiums are priced depending on the expected volatility in the market for any particular point in time. So today, as per the volatility, as per the forecasting, markets are expected. So as per the options premium pricing, the markets are expected to move plus or minus 70 points by the end of the day. That is the reason we see that the combined premium of ATM straddles is 70. So this is the first logic that we need to understand when we are selling straddles. So now the next question is, if the markets are to stay within a range of plus or minus 70, then you are going to make profits. But what if the markets start moving beyond 70, beyond plus or minus 70? In that particular scenario, you are having an exposure to a risk, which would keep on increasing as the market goes extremely bullish or extremely bearish. So theoretically speaking, your risk is unlimited. because markets can move up 1,000 points also and fall down 1,000 points also. Okay, but I'll show you how to manage the risk. So keeping this point in our mind, let's actually just move forward. So here once again, I'm coming into the Fyers dashboard. And here once again, we see 18,250 call and 18,450 put, which was sold at a comparative premium of 73. Currently, the call option that we sold is trading at a premium of 38, whereas the put option that we sold at 20 is trading at a premium of 26. So when we entered the trade, the combined premium at entry was equal to 53 plus 20, which is nothing else but 73 points. Whereas the current combined premium, if you have a look at it, is 40 plus 25, which is nothing else but 65 points. So if you're speaking about this, we entered the spread. The spread entry in straddle was at 73, whereas the current spread premiums are 65. So you sell at 73, and currently if the combined premium was 65, that means the difference in the two, which is 8 points, is your profit. So at the moment, we are running at 8 points profit, which is nothing else but the difference of our entry spread and the current spread. Now let me tell you what our logic is. For that purpose, I'm once again getting back into the charts of Nifty, which is currently trading at 18,262. So one more thing, if you are a Fyers user and if you're looking forward to automate this particular strategy that I'm discussing with you on Fyers, you can feel free to get in touch with us on our WhatsApp, which is 9544-085-264 for the algo automation purpose. Or you can actually connect with us on any of our social media handles, which goes by the tag livelong_Hari, which is available on Twitter, Instagram, Facebook, LinkedIn, or whatever social media platform you want. We are also there on YouTube. Okay. Yeah. So now let's understand for ourselves when we will be coming into loss. So now we realize that we are in a small profit, which is nothing else but the difference between our entry and our entry combined premium and the current combined premium. That is the profit that we have, which is 8 points. So could you just think for yourself what would be the situation or what would be the scenario when we would in fact come into loss? Okay. I will definitely tell you, I'll definitely help you understand how much is the margin requirement for doing a naked straddle, strangle, and how you can reduce the margin requirement by hedging purpose. Everything I'll show you, don't worry. So I'll just make sure that all your queries are attended to, but let me just follow the same sequence that I'm explaining. Okay. So could you please tell me what would be the scenario when we would probably be having to take a loss by doing a straddle? So in today's case also, just try to answer like what would be that situation where we probably would be having to take a hit or a loss. Okay, you can just let me know to the chat box. High momentum at last hour. Okay, it is not just with respect to high momentum at last hour. So if there is a high momentum that is coming in between, that is, if at all we have a very high momentum coming in between, then also we could actually have a situation of taking a loss. Okay, that is like, let's say market is going extremely bullish or extremely bearish, or it does both. That is like a V-shaped move. If market goes extremely bullish, extremely bearish, or if it does both, which we refer to as a N-shaped or W-shaped or M-shaped market condition, extremely up it moves, extremely down it moves, zigzag it moves. So that would be a situation where we have to take a loss. So how are we going to protect ourselves from a big loss, or how are we going to do the risk management in this particular scenario. That is what we have to discuss now. So for that particular purpose, let me once again just get back into our whiteboard. So this is our contract once again for you. Okay. So we know that the combined premium over here was 73 at the time of entry. And also we know that plus or minus 73 points is the buffer we have from spot of Nifty. So plus or minus 73 points is the buffer we have from the spot of Nifty for us to remain profitable by the end of the day. So also as a straddle seller, just a second, yeah. So also as a straddle seller, I had just mentioned extreme moves on the upside or extreme moves on the downside are actually the scenarios where we end up taking a loss, correct? So now what if we have a mechanism where we exit the straddle based on the combined premium itself? So let me ask you, we are selling a straddle at a 73 rupees combined premium. That is, we are actually taking a spread, or we are kind of actually doing this particular short straddle and have entered it at 73. So what is the maximum profit potential we have? So in this particular scenario, as all of you know, the straddle that we have entered was 18,250. So 18,250 straddle is what we have entered. I'll just show it to you once again. So once again, if I'm just coming to the screen. So 18,250 short straddle is what we did. So what is the maximum profit potential we have? So when you're selling a straddle, so you know that at the money call options and put options, your market exactly settles at 18,250 at the end of the day. The combined premium of 73 is going to become 0, which is very, very less likely because market settling at 18,250 will not happen. It is just like winning a lottery ticket. Exactly at 18,250, chances of it settling is very less. But theoretically speaking, what is your maximum profit potential? So just let me know through the chat box. So what do you think is your maximum profit potential theoretically? Okay. So theoretically, your maximum profit potential is nothing else but the combined premium itself, that is 73. So if I'm just to write down the numbers, it would be like 73 into 50. Okay. So 73 into 50 is basically going to be your maximum profit potential. The markets are to settle exactly at 18,250. That is the strike where we sold it. This is your maximum profit potential. So how much is the 73 into 50? Okay, 70 points shooting, which is nothing else but 3,500 rupees per lot. So per lot, you're going to make 3,500 rupees. So here though we are kind of actually trading 10 lots. That is our maximum profit potential is 35,000 rupees. That is 35,000 rupees is the maximum profit that we can potentially generate out of this trade if market is exactly settling at 18,250. Now the second part I wanted to ask you. So when you're trying to make 3,500 rupees per lot, or in this full position, it is 35,000 rupees. What do you think should be the maximum risk you should be ready to give? Or what do you think should be the maximum loss that you should be ready to take? So just think about it and just let me know what you feel about the maximum loss that you shall actually be ready to give to the markets. If 3,500 is the maximum profit that you're ready to make. Okay. So some of you are saying 2% maximum 73 points, which is equivalent to the maximum profit that you can make. So what you're trying to say is the maximum profit that you should, the maximum loss that you should be ready to take should be equal to the maximum profit that you could potentially make. Okay. So in this particular system that we have, we have a different way of looking at it. So as Vivek is saying, what we would be doing is whatever is the combined premium. So in this particular case, I know for myself the combined premium is 73. Due to the very same reason, I will make sure that I have at least 4 attempts to do the straddle for the entire day. So first, let me just tell you on an expiry day, what is the chances of you making money by doing a straddle? So once again, if I'm speaking theoretically, you have almost 60% chances of making money in a short straddle on an expiry day. So on an expiry day, you actually have like 60% chances of being profitable by doing a short straddle. Now let me quickly give you an example. Let's assume that you're tossing a coin. Okay, you're tossing a coin and you know that the outcomes of tossing a coin are 2. So what if you toss the coin 4 times? The outcomes of each toss that you're going to do is basically once again heads or tails. So irrespective of the fact that in the first attempt or the second attempt you're getting a heads or tails, the outcome of the third toss is totally going to be independent of the outcome of the first 2 tosses. The same way when we're doing straddles also, the chances of you making money on a short straddle is 60%. So now what if you have 4 straddles to do for the day? Or what if you take 4 entries with the same straddle that you're doing? Okay, it is going to be 60% chances of making money in each of the straddles, and towards the last straddle that you probably have, your chances actually reduces to maybe 40% or 50%. Why? Because your premiums come down. So lesser the premium, higher the risk. But generally speaking, once the premiums are less, the tendency of the market to give big moves are also on the lesser side. So once again, just like taking a health insurance, the premiums are less, the chances of the person to claim the insurance is also going to be very, very less. Okay. Due to the same reason, what we are going to do is when we are trying to collect a maximum profit of 73, as all of us know, which is almost impossible, we'll just make sure that the maximum risk that we are taking by doing the short straddle for a combined premium of 73 is in fact 25% of the premium that we collect. That is, if 73 rupee is the short straddle that we are kind of actually doing, we'll make sure that the maximum loss that we are going to make is going to be 25% of the 73. So I'll just give you the exact numbers. So when we're selling at 73 combined premium, we'll make sure that at any particular point in time, our combined premium expands to 91 will come out of it. Okay. So when we are selling the straddle at 73, we just make sure that by any chance, the premiums are expanding to 91, which is nothing else, but at any point in time, we are taking a loss of 18 points. Will just come out of it. Okay, so so here also today, in today's scenario, once again, I'm getting back into the charts. See, we sold the straddle at a combined premium of 73, and currently the trading premium is 30 plus 35, which is 29 plus 35, which is 60. 64. Okay, 64 is the current traded premium. Our entry was at 73 combined premium. Now, at any point in time, as I mentioned to you, if the combined premium increases to 91 or expands to 91, we'll book this loss of 18 points and we'll just come out of it. So if I look at the risk to the reward, we know that the maximum risk potential that I have in this particular straddle that I took was 18 points. Now, what about the maximum profit potential that I have? 73 is almost practically impossible, so I'm assuming it to be 60. See, combined premium coming down to 73 is like you winning a lottery ticket. Okay, it has happened 3 times the last 1 year, but chances of it happening is like very, very less. So I'm expecting that we can collect a combined premium of 60 and the risk that I'm taking is 18. So I'll just round it off to 20. So what is the risk to reward that you have? It's nothing else but almost 1:3. That is, by taking a risk of 20 points, you are trying to collect 60 points. Correct. So the risk reward that you have is 1:3. So once again, I'm specifically mentioning this particular logic will work purely on expiry days. This is not practically feasible for any other trading day. This is meant only for expiry days. Okay. So 1:3 risk reward ratio you can actually collect in your first attempt. If things are in your favor, if the markets are actually staying sideways, you will make money. On the other hand side, if it goes extremely bullish or extremely bearish, you are going to come out as soon as your combined premium increases to 25% of your entered combined premium. So this is the first logic. So I hope the first logic that I have explained to you is clear for everyone. Yes or no? So any queries you have, you can just let me know to the chat box right now. So any questions you have on what I have discussed till now, you can just let me know to the chat box right now. When to enter, when to exit, everything I'll tell you. So, but let me just once again follow the same sequence. The first concept is okay. Any quick questions? Anyone? Yeah, execution can be done all automatic. How did you come to 18 point stop loss? I told you 25%. So this is actually based on backtesting. Okay. The strategy is for Nifty index only. So let me tell you, like we ourselves are running this for Nifty, Nifty, and recently we have started this with crypto options as well. Okay, Nifty, Nifty, and we have recently started this off with crypto options as well. Please speak in Hindi. So this particular session I'll continue in English, but since many of you have been asking to explain this concept in Hindi, what I'll do is on our YouTube channel, whatever I have explained in English, I'll make a translation to Hindi and put it up on our YouTube channel for sure. Just give us 1 week time, we'll put it on our YouTube. Okay, I think I can just, no, this won't work anywhere else. So I'm just moving forward and with the next logic. Okay, so this is the first logic I wanted to explain. Whatever the combined premium at which you enter, 25% of that is going to be your stop loss. Okay, on the combined premium itself. Once again, I'm mentioning your stop loss is actually going to be on the combined premium, 25% of your entered combined premium. Okay, coming back, just getting back. So right now, if you have a look at it, we are running at almost 10% of our maximum profit potential for the day, which is 53. Let's see, and let's have a look at the change in combined premium right now. So already we discussed entry combined premium was 73. Current combined premium at the moment is 30 plus 31, which is 61. So our profit is nothing else but 73 minus 61, which is 12 points into 500. Okay. So what is 12 points into 500? It's nothing else but 6,000 rupees. So 6,000 rupees is the profit right now. So here you can see that the running profits is 3,500. Why? Because this particular account had some other positions that was happening in the morning. Okay. So this particular like account actually had some other strategies also running in the morning. That is the reason the variation is there. So 6,000 rupees is the current running profit from the straddle that we have done. So I hope it is clear so far. Okay. So next, what I'm going to do is, what are the next logic or what is the next condition for re-entry? So if the combined premium is not expanding after our entry, there is nothing for us to do. You hold on to the position. That is, we'll enter the trade at 9:50. Sorry, we'll enter the trade at 9:30 a.m. in the morning. Okay, we'll kind of think about entering into positions at 9:30 a.m. in the morning, and we'll just come out of the positions by 245. Okay. So by 245 will kind of come out. Or there is also another condition that we look at, that is if any significant key resistance level or support level is getting broken and the premiums have also shrunk a lot, then we'll actually think about taking an early exit that could probably be by 1 p.m. or even 12 p.m. Okay, so this particular condition actually depends on any particular key level getting broken, and we are currently looking at this particular concept with the help of CPR. And at this point in time, it is little bit elaborate. It's going to be a very broad area to speak about. So I'm not touching about that part right now. But you can consider this way: you enter at 9:30, you come out of the positions by 2:45. So what's the next part? Let's get into it. So after our first entry, that is after our first entry, if the combined payment was expanding and hitting the stop loss, we'll look out for a next entry. Okay, we'll kind of actually look out for a next entry once again wherever the current spot price is, and again redo the logic. So we'll create a new short straddle wheresoever the market is, and once again we'll keep a combined premium stop loss of 25%, and we'll keep on repeating the process over and over again. And we'll keep continuing the process till the point in time you are taking a loss of 2% of your capital. Till a point in time, you're taking a 2% loss of your capital, you'll continue doing the process. So here, this is an account with a 10 lakh capital. That means in this particular account, the process is going to be repeated over and over again till the point in time we actually book a loss of 20,000. So once again, what is the profit that we are trying to make if things are in our favor? I told you if 60 points premium, if we are able to eat, then we are going to make a profit of almost 30,000. But what is the maximum risk that we are trying to take? It is going to be limited to 20,000 rupees. So things are so unfavorable, things are moving against us. We'll keep on repeating this straddles till a point in time we are taking a loss of 20,000 rupees on the capital. And this process will continue doing it till the end of the day. So after 12 o'clock or after 12:30, there is no point in you taking a re-entry because almost most of the premiums would have actually just decayed. Now the next part I'm going to do is I'm actually going to show you how you can do this, automate this particular strategy on Fyers and Tradetron. So here we have, so here we actually, okay, not this. Same only, but I'll show here. Okay. Capital requirement, everything I'm coming into, just please allow me some time. So the name of this particular strategy that we have is what we refer to as a baby strategy. The name, why we are calling it as a baby strategy is because of the fact that we can do this with a very small capital also. Okay. So can anyone tell me like what are the capital requirement for you to do one lot short straddle? Can someone please tell me what is actually the capital requirement that you need in order for doing one lot short straddle Nifty? So what do you think is the capital requirement that you need to do one lot of short straddle in Nifty? Okay, so our friend Abhishek is saying 1.2. Harish is saying 55 lakhs. Okay, so yeah. Santosh is saying okay, 1.51. Okay, so 2 lakhs. Okay, we're getting different answers. So let me just tell you, if you want to do a naked short straddle, you can actually do it with 1.5 lakhs. Yeah, sure, Naresh, got it. Okay, I'm just going to show that. So you can actually need a 1.5 lakh. At 1.2 also you can do, but keep it to be 1.5. So you need 1.5 lakhs to do one lot naked short straddles in Nifty. But we would highly recommend that rather than doing you doing it naked. So when you're doing a short straddle, okay, you do an at the money short straddle, and along with that, you consider buying an out of the money call option and put option for 1 rupee, 1 rupee each. So for 1 rupee each on the call side and put side, you buy hedges. So here, in this particular case, if we have, so in this particular case, if we have actually done an 18,550, sorry, 18,250 short straddle, 18,250 call and put we have actually done. We are buying an 18,550 call and a 17,950 put for 1 rupee, 1 rupee premium, which is just for purely hedging purpose. So we are already understanding or ready with the fact that we are going to be losing this 2 rupee premium for hedging. So this is an hedging expense, and every week I would highly recommend that you have hedges in place. So by doing this hedging, let me tell you, your margin requirement is going to reduce down. Okay. From 1.5 lakhs or 1.2 lakhs, your margin requirement is easily going to reduce down to 85,000. So you can reduce down your margin requirement to 85,000 from 1.5 lakh per lot. But the question is, can you do the strategy in one lot? The answer is yes, you can do this particular strategy in one lot also. But overall, when you have a look at the results, when you're doing it with one lot, whatever profits you're going to make is going to be eaten up by the charges. So it is highly recommended that if you want to do this particular strategy, you can keep 3 lakh rupees and you can do this on margin. You need not keep separate cash for this. Rather, whatever stock portfolio you have, you can pledge it, generate margin out of it, and then do short straddles purely for the expiry days. Okay, so 85,000 rupees is the margin requirement that you require to do one lot short straddles in Nifty. But highly recommended you keep at least 2 to 3 lakh rupees and do 3 lots, because that is where. So here we are actually showing a scenario where we are actually hedging with 17,950 put and 18,550 call of 1 rupee, 1 rupee each. Straddle is being done at 18,250. So once again, I'm just telling you, if you need any help on automating this particular strategy, you can WhatsApp us directly on 9544 085 264 for this algo automation. Also, you can actually just keep in touch with us and connect with us on our social media handles, livelong_Hari, which is available on Twitter, Instagram, LinkedIn, Facebook, and all other platforms out there. Okay. Now, let me just get back to the charts of Nifty once more, and let's see where Nifty is for now. And then I'll show you how to run this, generate the APIs, everything, and trade it on on Fyers. This will be free of cost for all Fyers users. So right now, this particular strategy, anybody who wants to automate it, for all the 100 people of you, it is going to be free of cost. Okay, so it is exactly at 18,254. That means the spot price at which we entered and the spot price right now is almost same. That means we are getting better profits. So our entry premium was 73. Right now the combined premium is only 54. Okay, so we have a gain of 10 points, which is 5,000 rupees profit. Now, if you are a Fyers users, and you must be familiar with the fact that Fyers have trading APIs for algo trading. So could you let me know through the chat box how many of you are already into algo trading? So how many of you attending this meeting are currently doing algo trading? Okay. So what about the rest? Okay. So let me tell you, algo trading is not as complex as it seems. It is nothing else but a process where you can automate your trading strategy if you have clear-cut entry conditions and exit conditions to follow. Just like in this particular strategy that I'm discussing right now. Okay, so if you have clear-cut entry conditions and exit conditions to follow, then you can actually have the execution happening on algo and you can actually automate it. So being a Fyers users, what you'll have to do is you'll have to generate APIs. And Fyers currently is one of the brokers out there who are providing like very stable APIs, and that also at free of cost. Okay. So whereas some of the other brokers, if you want to get into algo trading or if you want to do API based trading, you have to pay almost a subscription fee of 2,000, 3,000 rupees per month. which is little bit on the expensive side for someone who's trading with a smaller capital. Whereas Fyers will actually provide it to you free of cost. Okay, that is one advantage that you have. Now, then what you should be doing is you shall actually be creating an account with Tradetron. And friends, let me tell you, like my team would be more than happy to help you and assist you with this particular automation process, and it is going to be completely free of cost for you. All the people who are attending this meeting is going to be absolutely free of cost. So what will be done is you'll be creating an account in Tradetron, and after that we'll be giving you access to the algo. So that is whatever algo we have, that is this baby strategy algo that we have. We'll be sharing the codes with you. Sharing the codes. There is this process called as brokers and exchange. That is going to be there on your Tradetron account. So you'll be clicking on brokers and exchange. And after clicking on the same, you can just mention the broker that you want to connect with. So now once you're connected with the broker, you'll be updating your API keys, everything over here. So this particular process, for this particular process, you will in fact have to log into your Fyers account, enter your trading tokens, all those things. And every day morning at 9 o'clock, once for the day, you have to generate token. There is a security process by SEBI, which is mandatory for every algo trading user to activate the token on a daily basis. So you'll have to come to Tradetron and you'll have to refresh on the token every day morning. So today you can see that at 9:38 a.m. we have refreshed the token. So pause this. You're ready to go. You're ready to do your algo trades, and the strategy would be deployed through Tradetron only. That is, you can all the time access it to your web app. Now, once this is deployed, you can just see that, okay, the strategy is actually running. So here, this is a variation without hedge. This is a variation with hedge. Okay. Yeah. Then that's it. The strategy itself will automatically check for the combined premium. So at any point in time, the combined premium is increasing, the strategy will exit, will create a new straddle, and the process will be repeated over and over again till a point in time, our exit condition that is going to be 245.3 is met, or at any point in time, our combined premium has expanded to 25% of your entry. So by any chance you're taking a 2% loss on capital on any day, then also the entire position is going to be squared off. Okay. So this is not so tough for you to automate. Now somebody who would like to see this on virtual mode. So now there could be many of you. So today, okay, the strategy is actually making profits. You probably would be pretty much impressed by the performance of the strategy, and the logic also would be very convincing for you. But let's say that you want to see how this particular logic works for a while. That is, you want to try this out for a month, this out for the next 2 weeks, and then deploy it on your actual capital on Fyers. That can also be done. Why? Because we will actually be setting it up for you on a demo mode also we can give you. See for yourself for 2 weeks and then deploy it on your real-time capital. So for you to get started with the strategy, once again, you can contact us on 9544085264. You can just WhatsApp us. We'll help you automate the same. Do we need to buy package for Tradetron for connecting to Fyers API? Yeah, you actually need to go with a basic package, but for virtual mode, you really need not pay anything. And I think that will hardly cost you some 100 rupees per month. That's not a big amount. And we are closely working with Fyers to make the exe files that can be done. So it'll be 100% free of cost. So now it'll be hardly 100 rupees that you have to pay through Tradetron. Yeah, you can actually get it for free. If you're already having Tradetron, still you can get it. If you don't have Tradetron also, you can still get it from us. You can just contact us on this particular WhatsApp number and we can actually set it up for you. So once again, I'm mentioning, you can just contact us on this particular number, also on our social media handles. So you can just get in touch with us, livelong_Hari, or our mobile number 9544085264, and we can set up the automation for you. We can show it to you or we can set it up for you on demo mode also. Okay. Yeah, you will be providing with the recording as well. So I think I can get some questions right now, and post this towards the end of the day. Once again, I will connect with you all and I'll show you what happens with the system, because else this is just going to continue till 3:30 market closing. So today at the end of the day, once again, I'll connect with all and we'll actually show you what happens with the system and what's the update. So Fyers API is absolutely free of cost and it's like one of the best APIs out there in the market. So you can actually just use it. So in fact, if you are a paid user who is using some other brokers APIs also, you'll be able to figure out like how stable and how comfortable it is for you to trade on Fyers, even though they're giving it completely free of cost. You're not doing algo right now, but still you want to do it. See, if you are a complete beginner to trading, or if you are not at all someone who has used algo earlier, my team will actually show you demo on how to get started with the same. So how to connect this with Fyers API, everything will set it up for you. We'll actually show it to you like over a Zoom call one by one. The reason I'm not exposing the API keys or something right now is because these are secret codes. Okay, so if you have access to my API key, then the problem is that you can take trades in my account also. So due to the same reason, it is not possible to stream the API keys, especially to a very large audience. So that's the reason one-on-one consultation we can have. My team can actually just show a demo to you on how to use or how to generate the APIs and set up the tokens and everything. So in fact, there are a lot of reference material also. I'll share one document with you that will be shared with you on how to generate Fyers token. It's already there on the Fyers help dashboard. So if you already have a Fyers account, yeah, well and good. So if you already have a Fyers account, it is very easy. All you have to do is just generate the API keys. This will hardly take you 5-10 minutes. Connect it with the Tradetron and get started with trading. So we'll help you with the same. You need not do anything on that part. Is Tradetron free with Fyers account? Tradetron will see for Tradetron will hardly cost you 100 rupees per month. They are charging this for you to set up the algo there. I don't think 100 rupees per month is a cost. So any questions you would like to ask? So if no other queries are there, then we'll connect towards the evening, today evening, and I'll update you what happens with the trade for the entire day and what is the outcome. So thank you. So thank you for sparing your time. I will share this, all the reports, everything I'll share with you. Not just the backtest, I'll actually share the actual reports with you. Okay, I think that'll be more convincing. The coding, Tradetron coding is something different. We have it on Python script also. Then Lakshmi ma'am, like I will once again share it with you on your this thing on the mail. Like you will get a mail. Okay. Yeah. So for any queries you have, you can contact me on this particular number, WhatsApp, or you can connect with the server or with us on our social media handles. So thank you all. So we'll kind of connect towards the end, and we will kind of. I'll show you the results also. What is happening? What are the output? Everything that we're getting. Towards the end of the meeting. So I think I'll take some questions. You can start asking your questions. So I have explained the strategy part. Okay. You can just start asking questions, right? Is it running daily or only on expiry? So this is actually meant only for expiry. So you can do this on Nifty expiry and also on Nifty expiry. Okay. So if other expiries are coming, we know that like BSE, Sensex expiry, all those things have come up. So once we have liquidity, we can actually get started. So once we have liquidity, we can actually just get started. So I'm just going to take all your questions. Don't worry. Can you share? No, nothing. Can I get video link? Yeah, I'll definitely be sharing the video link with you. Definitely. Yeah, obviously we have to keep